You do not control your money. A small group of institutions decides how much exists, what it costs, and who gets it first. And by the end of this video, you will understand exactly who they are and how they shape your future. Most people believe money is neutral. They believe it simply exists. They believe governments print it. They believe banks store it. That belief is incomplete. Money today is not created by governments directly. It is created through a system, a layered structure. Central banks at the top, commercial banks below, financial institutions surrounding them, and you at the bottom. Let us start at the top. Every country has a central bank. In the United States, it is the Federal Reserve. In Europe, it is the European Central Bank. In Japan, the Bank of Japan. These institutions control monetary policy, they control interest rates, they control liquidity, they control how much money flows through the system. They do not just print cash. Most money is digital, numbers on screens, entries in databases, balances in accounts. When a central bank lowers interest rates, borrowing becomes cheaper. When it raises rates, borrowing becomes expensive. That single decision influences mortgages, car loans, credit cards, business expansion, stock markets, and employment. One rate, millions of consequences. Now ask yourself something. Who appoints the leaders of these institutions? Who influences their decisions? Who benefits when rates go down? Who benefits when rates go up? When rates are low, asset prices rise, stocks rise, real estate rises, bonds inflate. People who own assets benefit first. People who do not own assets feel prices rising later. When rates rise, borrowing becomes painful. But large institutions often already position themselves. They have access to information. They have access to capital. They have access to timing. You do not. This is called the Cantillon effect. New money enters the system at the top. Governments borrow. Banks lend. Corporations expand. Asset holders buy. By the time money reaches you, prices have already adjusted. You receive inflated dollars. They receive fresh dollars. That difference compounds over decades. Now look at commercial banks. They do not simply lend money they have. They create new deposits when they approve loans. When you borrow $100,000 for a house, that money did not exist before the loan was issued. It is created in the process. Your signature becomes money. Your obligation becomes currency. Debt is the source of money. That means the system requires borrowing to grow. No debt, no expansion. No expansion, no growth. So what happens when people stop borrowing? Recession, contraction, crisis. That is why the system encourages debt. It depends on it. Now step back and look at the structure. Central banks influence rates. Commercial banks create credit. Financial markets amplify liquidity. Governments issue bonds. Corporations borrow. Households borrow. Everything is interconnected. Everything is leveraged. Everything depends on confidence. If confidence drops, panic begins. If panic begins, liquidity dries up. If liquidity dries up, collapse accelerates. That is why central banks intervene. They inject liquidity. They lower rates. They purchase assets. They stabilize markets. But every intervention has consequences. Every rescue increases long-term distortion. Every bailout increases moral hazard. Every stimulus increases dependency. Now here's the uncomfortable truth. This system is not necessarily evil. It is powerful. But power without direct accountability concentrates influence. And concentrated influence shapes outcomes. You do not vote on interest rates. You do not vote on quantitative easing. You do not vote on liquidity injections. But you live with the results. Inflation, asset bubbles, market crashes, currency devaluation. These are not random events. They are outcomes of policy decisions. Policy decisions made by a small group of people. And that is where the real question begins. Not how money is created, but who ultimately directs its flow. To understand who controls the money, you have to understand how this system was built, because it did not appear overnight. It evolved, it hardened, it centralized. For centuries, money was physical: gold, silver, metal coins. If you had it in your hand, it was yours. No database, no digital ledger, no remote authority. But carrying gold was dangerous, heavy, difficult, risky. So people began depositing gold with goldsmiths. Goldsmiths issued receipts. Those receipts became tradable. Soon, people stopped moving gold. They moved paper. And here is where everything changed. Goldsmiths realized something powerful. Most people never came to withdraw their gold at the same time, so they started issuing more receipts than gold they actually held. They created money backed by partial reserves. That was the birth of fractional reserve banking. From that moment forward, money was no longer fully backed. It was confidence-backed, trust-backed, system-backed. Governments noticed this power. If banks could expand money through credit, economies could grow faster. Wars could be financed. Infrastructure could be built. Expansion could accelerate. But with growth came instability. Bank runs, panic, collapse. Every time confidence broke, the system cracked. So governments stepped in. They centralized authority. They created central banks. Institutions meant to stabilize crises. Institutions meant to act as lenders of last resort. In the United States, after repeated financial panics in the 1800s and early 1900s, the Federal Reserve was created in 1913. Its mission was stability. Its tool was control of the money supply, control of interest rates, control of liquidity. But centralization always concentrates power. When gold backed currency, limits existed. You could not create unlimited money. You were constrained by reserves. But in 1971, something historic happened. The United States ended the gold standard. The dollar was no longer convertible into gold. From that moment forward, money became purely fiat. Fiat means by decree. Money exists because the government says it exists, not because it is tied to a physical asset. That decision changed everything. Without gold as a limit, money creation accelerated, debt expanded, asset prices climbed, inflation cycles intensified, economic growth became increasingly dependent on credit expansion. The system was no longer anchored to metal. It was anchored to confidence. Now understand this clearly. When money is tied to gold, expansion is limited. When money is tied to debt, expansion has no natural ceiling. Debt fuels growth, growth fuels asset prices fuel borrowing, borrowing fuels more debt, and the cycle continues. But who manages this cycle? Who decides when to expand? Who decides when to contract? Who decides when to rescue markets? Who decides when to let institutions fail? Central banks, policy committees, financial authorities. They meet, they deliberate, they vote, and their decisions ripple across the globe. A rate cut in Washington moves markets in Tokyo. A policy shift in Europe impacts loans in Latin America. The system is global, interconnected, interdependent, and fragile, because it depends on perception. As long as people believe the currency holds value, it holds value. As long as investors believe liquidity will remain, markets rise. As long as borrowers believe growth continues, debt expands. But if belief fractures, panic spreads. And when panic spreads, central banks intervene again, lower rates, inject liquidity, buy assets, expand balance sheets. This is called quantitative easing. It sounds technical, it sounds neutral, but it means one thing. More money enters the system. And more money benefits those closest to its source first. Banks, financial institutions, large asset holders, corporations. By the time liquidity filters down to wages, to savings, to ordinary households, asset prices have already adjusted upward. Housing becomes more expensive. Stocks become more expensive. Education becomes more expensive. The ladder rises as you try to climb it. That is not coincidence. That is structural flow. The system is built to stabilize from the top down, not from the bottom up. And now the deeper question emerges. If central banks influence money supply, if commercial banks create credit, if governments borrow endlessly, then who influences the influencers? Who truly sits behind monetary power? Now we move deeper. Because central banks do not operate in isolation. They exist inside a larger network. Governments need money. Governments spend more than they collect. The difference becomes debt. That debt is issued as bonds. Those bonds are purchased by investors, by institutions, by foreign governments, and by central banks themselves. This creates a cycle. Governments spend, they issue bonds. Banks purchase bonds. Central banks support liquidity. Debt grows. Over time, national debt expands faster than the economy. Look at the numbers. In 1980, United States national debt was under $1 trillion. Today, it is above $30 trillion. That growth did not happen randomly. It was enabled by a system that allows continuous borrowing, continuous expansion, continuous rollover. When governments borrow, they promise future repayment. But repayment depends on future tax revenue, and future tax revenue depends on economic growth, and economic growth depends on credit expansion. It is a self-reinforcing loop. Now consider something even more powerful. Large financial institutions do not simply react to policy. They influence it. They provide research. They sit on advisory panels. They move between public office and private finance. Former investment bankers become treasury officials. Former regulators join financial firms. The line between public authority and private finance becomes thin, very thin. This does not require conspiracy. It requires incentive alignment. People move where power and compensation intersect. And finance is where both concentrate. Now look at global coordination. Central banks communicate with one another. They coordinate during crises. They align on liquidity measures. During the 2008 financial crisis, central banks around the world acted together. During the 2020 crisis, liquidity injections happened simultaneously across major economies. This is global monetary management. It is not chaotic. It is organized. Now think carefully. If liquidity flows through coordinated networks, if asset purchases support specific markets, if credit creation is structured from the top down, then capital allocation becomes directional. Money does not flow randomly. It flows strategically toward sectors deemed important, toward institutions deemed systemically significant, toward markets that must be stabilized, and when stabilization fails, bailouts occur. In 2008, major financial institutions were rescued. In 2020, corporate bond markets were supported. Airlines received assistance. Banks received backstops. Small businesses received delayed aid. Households received stimulus checks. But timing matters. Liquidity entered financial markets first. Asset prices recovered quickly. Stock indices surged. Real estate surged. Wealth concentration accelerated. Those holding assets benefited immediately. Those living on wages waited. This is structural advantage. And structural advantage compounds. Over decades, wealth concentrates upward, not because of secret meetings, but because of how liquidity flows, because of who receives first access, because of how policy transmits through the system. Now ask yourself something. If markets rely on central bank support, if governments rely on debt expansion, if banks rely on credit growth, what happens if the cycle stops? What happens if confidence breaks? What happens if inflation spirals? And what happens if debt becomes unmanageable? The system must choose between inflation and collapse, between currency debasement and contraction, between stimulus and recession, and every decision redistributes power. Now, here is where it becomes personal. When inflation rises, your purchasing power falls. When rates rise, your borrowing cost increases. When asset bubbles burst, your retirement shrinks. When taxes increase, your disposable income declines. You experience outcomes, but you do not influence decisions. That imbalance creates tension. Tension builds slowly, then suddenly. History shows this repeatedly. Monetary systems eventually reset, currencies weaken, debt restructures, confidence shifts, and those positioned correctly preserve wealth. Those unaware absorb loss. So the question becomes sharper. It is not just who controls the money, it is who controls the direction of value. Because control over money supply is control over time, control over growth, control over opportunity. Now, let us bring this down to your level, because systems feel distant, abstract, complicated, but their effects are personal, very personal. When central banks expand money supply, asset prices rise. That sounds positive, until you realize what that means. Housing becomes more expensive, stocks become more expensive, land becomes more expensive, the entry cost rises. If you already own assets, you benefit. If you do not, you fall behind. This is how wealth gaps widen quietly. Inflation does not hit evenly, it hits differently. The wealthy hold appreciating assets. The middle class holds wages. Wages adjust slowly. Asset prices adjust quickly. So over time, purchasing power shifts upward. Now look at savings. If inflation runs at 5% and your bank pays 1%, you are losing 4% per year, quietly, silently, without headlines. Over 10 years, that erosion compounds. Your money buys less, your time buys less, your effort buys less. You worked, you saved. But the currency weakened. Now look at debt. Debt is encouraged, mortgages, student loans, credit cards, car loans. Because the system depends on borrowing. When you borrow, money is created. When you repay, money is destroyed. This is how supply contracts. But notice something. Inflation benefits debtors in the short term. If wages rise slowly but asset prices rise faster, borrowers with assets gain leverage. Those without assets struggle. Now consider financial markets. Markets respond instantly to policy shifts. If interest rates drop, equities surge. If stimulus is announced, markets rally. But you do not get early access. Institutions analyze policy before it is public. High-frequency trading firms react in milliseconds. Capital moves faster than individuals ever can. The system operates at institutional speed. You operate at human speed. That difference matters. Now consider taxation. And when governments face rising debt burdens, they increase revenue. Directly or indirectly, taxes rise. Fees rise. Inflation acts as hidden taxation. You pay more without noticing legislative change. This is not random. It is structural pressure. Debt requires servicing. Servicing requires revenue. Revenue requires extraction. Now look at retirement systems. Pensions depend on market returns. Markets depend on liquidity. Liquidity depends on policy. Policy depends on economic stability. Everything loops back to monetary control. And if returns falter, retirement ages increase. Benefits shrink, contributions rise, the burden shifts to individuals, always downward. Now pause. This does not mean collapse is certain. It means leverage is high. Debt levels are historically elevated. Global debt exceeds global GDP by a wide margin. When debt grows faster than productivity, fragility increases. History shows this repeatedly. Roman currency debasement, Weimar hyperinflation, Argentina, Venezuela, Turkey. Currency confidence erodes slowly, then suddenly. But advanced economies operate differently. They export debt. They manage perception. They extend timelines. They innovate financial tools. This delays reckoning, but it does not remove structural pressure. And when pressure builds, policy becomes more aggressive. More stimulus, more liquidity, more coordination, more intervention. Each intervention stabilizes today and complicates tomorrow. So here is the uncomfortable truth. You live inside a system designed for macro stability, not individual fairness. It prioritizes systemic survival, not personal equality. It protects the structure first. Then it addresses the population. That hierarchy matters. And once you see it, you cannot unsee it. Because the question is no longer who controls the money. The question becomes how you navigate a system where control is centralized.